Welcome to the monthly webinar from Principal Wealth. It is April 1st. I'm Julina Ogilvie. I am welcomed by Bob Paolucci, our founder and CEO. Bob, welcome.
Good afternoon.
So we titled this month's webinar Crude Awakening, which is kind of a word play on the current environment. I'm going to describe in two ways, if I can, Bob.
Sure.
First being the phrase rude awakening, which is that sudden unpleasant surprise I think that a lot of us are feeling with the markets right now. And we're coupling that to replace rude with crude to address oil, the rise in price, the tension concerns around everything going on geopolitically, inflation concerns, economic concerns. And we want to address all that in the webinar today, if that's fair.
That's absolutely fair. And crude is definitely a play on oil. That's why it's there. So well said.
There we go. Well, kudos to whoever named it. It wasn't me.
Yeah.
So the agenda today is really not out of our cadence here. We're going to talk about the markets, the economy and policy, market anomalies, excuse me, and end with everything else. And Bob, any comments before you want to dive in or?
No, it's a number one, it's a midterm election year. Midterm election years are, not terrible, but there's usually a little bit more volatility that you see throughout the year. This is something that we talked about monthly for the past few months.
Yeah.
Expect a little bit more volatility. We got it. We got it on the back of a war that we're in, but really it wasn't war that did it. It was the short-term spike in oil prices. So there is a very highly correlated price of oil rising and market coming down. Um, Computerized trade by a lot of the technicians and these quant funds. But it seems like we're sort of exiting that. Um, and it seems like we're currently, as of April 1st at 1:50 p.m., working on a plan to sort of back out of this war that we're in.
Okay,
So
great. And I
market
think
needs to be reacting well to that.
yeah, and we've got some great slides to address some of the concerns that we've been hearing from you all. And so I think to kick it off in regards to the conversation around the markets and the recent volatility, we want to first put it into perspective a couple of different ways. And one is we always joke that the market doesn't go in a straight line. However, it kind of has gone in a straight line
Yeah.
for almost a record period.
Yeah. So, I think a lot of people listening are wondering, well, what's the market doing? Well, the S&P 500 is down 4.5% year to date. That doesn't include today. If the market closes, the market's up about 2%, 1.5%. So far for the day. We'll see where it closes. But year to date, after yesterday's big rally, March 31st, the large rally of all the indices, um, the market is down only 4.63%. The past 6 months, it's down 2%. The past 12 months, it's up 16%. The past 24 months, it's up 24%. In the past 36 months, it's up just about 60%. So uh, I think in the grand scheme of things, if you have a little bit of perspective, things are still very good. We had a little pullback that was needed, and we talked about that.
Yeah.
Number one. Number two, the S&P 500 had a 9-month consecutive positive month streak that ended last month. The Dow had a 10-month positive streak that ended this month. So there's not much to complain about here. The market had a slight pullback for a month,
Sure.
which ended up being slightly negative for a quarter, first
Mhm.
quarter of the year. Completely normal. Not much to see here.
Yeah.
There's no bubble talk going on anymore. What we will talk about and get into is beneath the surface, the average stock in the market pulled back quite a bit more, but we'll get into that in a minute.
Yep.
So one thing to remember, pullbacks are normal. Usually there are on average 5% or more pullbacks during the year. We were just in one. We may be out of it. It did not reach down 10%. The NASDAQ did, but the S&P 500, which is the broader, bigger index, did not quite reach 10% down.
Mhm.
We historically don't get too excited if there's a drawdown of 10% or less. We just call that sort of normal market activity because it is. It happens all the time. We do get excited if there's a drawdown of 10% or more. So when we do our big buying for clients, it's usually in the 10% or more camp. Uh, More specifically, we like to take advantage of 15% or more declines,
Right.
which are rare. We nibbled a little bit when the market was near down, 8 or 9%. Um, and we were ready to take advantage of a bigger decline, but it doesn't seem like we're going to get it. So just remember, this is normal. These declines are normal.
Yeah, that's great. And you mentioned looking under the hood, so let's talk a little bit about that as well.
Yeah. So this is a view of two indices: the Russell 3000 on the left in yellow, which is the 3,000 largest U.S. companies. Uh, let's call it the U.S. Total Market Index versus the S&P 500 on the right. So if you look at the bigger index, the Russell 3000, this just shows you that 50% of the index has drawn down 20% from its highs. So
Mhm.
the 3,000 companies in the Russell 3000, about half of those companies have pulled back uh, to the 20% mark, right?
Mhm. Yeah.
That usually is a sign that the selling is over because there's sort of a bear market within individual stocks, but at
Mhm.
the index level, because of who didn't decline, when you
Yeah.
glue it all together, you had so far at worst, about a 9% decline,
Yeah. Great.
right? So there's been a lot of carnage beneath the surface, but at the diversified, glued together level, there hasn't been nearly as much. So there has been a good correction beneath the surface, not so much on the surface. But we'll call it a day and say, okay, that's enough.
Yeah, absolutely.
Any more from here, we're more than willing to take advantage of and buy.
Great. And I think another way to sort of look under the hood is by sector and to see how broad this has gone as well.
Yeah, so to prove our what we were saying at a deeper level, this is looking at the sector, in some cases a subsector level. These are the percent of the stocks, the members of the sectors that have sold off by greater than 10%, greater than 15%, greater than 20%. And you can see proof is in the pudding. There's been a lot of pulling back of some of the components of each sector,
Uh-huh.
maybe minus like energy and utilities, which usually means that maybe in the coming quarter, some of those will cool off because everything else has cooled off.
Okay. Great.
Yeah.
And we were talking earlier about how the fact that, for example, the S&P is down 4.65%. And maybe some of the reason that our clients, investors in general, are feeling a little more anxiety is that from the top, from its peak, it's down 9. So if we can talk a little bit about where we are there.
Yeah. So it depends on when you look, right?
Mhm.
And investors have a way of looking or comparing. Um, they were worth this much on this one moment in time, on this one day, this one afternoon, and now I'm not. Oftentimes they forget that they may have withdrawn money from the portfolio, right? Oftentimes that they forget um, that the peaks and valleys continue,
Correct.
right? So, what are you comparing it to? What's your measuring stick? You know, are where were you a year ago? So if you're going to compare where you were 3 months ago, where were you a year ago?
Mhm.
You're higher today, significantly higher today. Um, yeah, so this is sort of the more granular makeup of the average drawdown of the stock in each indice. Um, uh, Index return from the April 8th low of last year. Down bottom, you have how many of the members of the S&P are outperforming the S&P. So what you're starting to see is um, over the past year, only 25% of the companies outperform the S&P within the S&P.
Right.
Now, you look over the past 3 months, it's up to 54%. So that is a lot more participation from the components of the market. So
Yeah.
that's a very healthy sign.
Yeah. Participation is great.
Yep.
And let's look at it a little more from a global perspective.
Yeah. What the TV doesn't tell you, the S&P, it's the best returning index so far year to date. Sorry, when it comes to when the conflict started with Iran.
Yeah.
So going back to March 1st,
First.
foreign markets are down twice as much, in some cases, 3 times as much as the US. Gold is down twice as much as the U.S. stock market. The emerging markets are down almost twice as much. The U.S. has become the sort of safety trade. Uh,
Okay. Yep.
yeah,
And let's talk a little bit about stock movement around oil volatility because we're clearly in this environment of concern.
yeah. This sell-off is in direct correlation to a spike in oil. It's so perfectly correlated. And there have been other times. That's why this chart is created, where we have these oil spikes and it sends the market down in a short period of time because oil spikes over a short period of time and then it
Hmm.
normalizes. This is a chart of showing you other periods where the spot price of oil has spiked 20% or more, and what the next 1 month, 3 months, 6 months, 12 months provides in terms of S&P return. And on average, 1 month later, you have positive 3%, 3 months later, positive 4, 6 months later, positive 6, 12 months later, this is shocking, positive 18%.
18% on
Yeah,
average.
on average.
On average.
Apple. Yeah,
Yes. It's amazing. I think that number will surprise a lot of people.
yeah.
And you you joked a little bit earlier about what happened to all this conversation around a bubble in sight.
Yeah. These are PE ratios of, some of the Mag 7 companies, the
Mhm.
largest companies in the United States, like NVIDIA, Amazon, Microsoft, Meta, Google, and Apple. The PE ratios have collapsed. So this is a chart of PE ratios going back about 5 years or so.
Mhm.
And I mean, it kind of speaks for itself. In aggregate, these companies have never been cheaper as a group. So you are getting a lot of earnings and a lot of earnings growth for the current price of these securities.
Yeah.
That's anything but a bubble. It's shocking that the price to earnings ratio of Nvidia is lower than ExxonMobil.
Yeah. Wow.
Yeah, so I mean, you're getting a lot of earnings for the current price of most of
Mhm.
these securities. So
Yeah.
that this is not what a bubble looks like.
Right. Exactly. And I think another way to kind of look at it, when you look at the value of the market, the price to earnings ratio, this is addressing the tech sector.
Yeah. So again, the tech is usually pretty volatile, but if you look on the left side, that is the PE ratio of the tech sector and how it bounces around. Where it was maybe 6 months ago, where it is today, again, it's a third cheaper. Number one, number two on the right, earnings estimates for tech um, have gone up. Not through all of this, they've gone up. So you really do have a much cheaper market all of a sudden. Uh, Less so because of the price decline, more so because of the earnings increase.
Yeah.
When you add them both together, you have this really, really nice opportunity here, which in essence elongates the bull market. There's a lot of to run here.
I think that that's a great point. And another way of looking at the markets longer term, and apologies to the consistent listeners, I feel like a little bit of a broken record, but we have to focus on the fundamentals.
Yeah. So the fundamentals of the equity market. So, corporate revenue continuing to climb, net earnings continuing to climb, buybacks continuing to climb, and dividends continuing to climb. This doesn't happen in a bear market. These are very positive things that are going on in the capital markets. The direction is higher.
Hmm. Yep, absolutely. And I don't know if you want to break into a Queen song here, Bob, but I think you titled that this I Want to Break Free.
Yeah. So the U.S. consumer, the U.S. economy, really just the United States in general, businesses, everything, we are much more sensitive to natural gas. Why? We have an abundance of it. In essence, they say a lifetime supply. You would think through a disruption in the Middle East that there would be some spike in the price of nat gas. No, we're energy independent. Um, we have seen the price of natural gas come down a little bit,
Hmm.
but the uh, more dependent markets, Europe and Asia, they've seen the spot price of natural gas skyrocket. So
Amazing.
again, dependency, you're more subject to disruption, whether it be price, global chaos, so on
Yeah.
and so forth. Here in the U.S., there's been really no movement in that gas. There has been in oil, but this is a view of natural gas.
Yep. And here's the description on oil.
Here's the view of oil. So very hard to see because it's on the far right hand side, and it's been such a sharp increase, mostly in Asian oil.
Hmm.
It's priced in Oman. Asian oil has uh, risen by almost 2x of what U.S. oil has. Again, the dependency that they have. European oil significantly pricier than U.S. oil, and really U.S. oil. This isn't really use driven or demand driven or even
Hmm.
supply driven. This is gambling. This is betting on short-term futures, oftentimes through investors in levered ETFs that are placing these levered bets on the short-term price of oil. Meanwhile, the long-term price of oil in the same commodities markets, futures markets, uh, is much lower. When you
Hmm.
look at 3 months, 6 months, 12 months, you know, years and years and years, the curve is so inverted. Well, there it is. Look at you.
Yeah.
Great timing.
I was trying to figure out when you wanted me to transition to, and I
Yeah,
figured
so
I'd
on
just
the
go.
left side, you have the current spot betting
Hmm.
price within the futures market. And then as you move to the right, that's time. The price like plummets. Um, and if you go out long enough, you really have the average price over, let's say, a couple of years, averaging out to about $60 a barrel, which is even lower than where it was before we started the war. So
Yeah.
it's just amazing what the short term trading manipulation can do to these numbers, how it can impact the market. Um,
Yeah.
that's why we say whenever there's an oil driven slide in the stock market, you buy it
Hmm.
and or you get ready to buy it.
Hmm.
And we dabbled a little bit. Again, it didn't go down nearly as much as we thought it would. Is it over? Maybe. Feels like it.
Yeah.
Can it retest certain levels? Certainly. If it does and goes down further than where it was, that's when we'll be buying pretty heavily. Um, but you can see how quickly the curve changes once you
Yeah.
get out of, months instead of days.
No, absolutely. Because this has obviously created a lot of questions and concerns around inflation, which I think goes to a great transition to talk about the economy and policy and talk about the Fed and what the Fed is stating versus what the market is expecting.
Yeah, you are on a roll with these slides. So,
Mhm.
the Fed just met 2 weeks ago, and what they said was number one, they think inflation is well anchored long term. They think, look, short term, you may see a couple of reports with the influence of oil rising, which could very likely be offset by housing declining.
Mhm.
Um, but they wanted to make sure that the world knew hikes are not on the table. They're not going to increase interest rates. Number one. Number two, not only are they not going to increase interest rates, they are still projecting 1 to 2 cuts before the end of the year. Something we talked about last month and the month prior
Right.
was, yeah, we expect at least 2 cuts before the end of the year. They sort of reiterated that with their outlook. They uh, uh, they mentioned, obviously, once we get through this period of war and more like activity, that the commodities markets will settle down, and they're not going to react too much to any short-term change in the inflation reports. So that also was a common factor, because the media has a way of running with all these wild stories.
No,
So it was a
absolutely.
very good meeting, a very um, clear meeting from the Fed with they are not really concerned about this. They are looking out months, and they're not going to pay too much attention to the next 1 or 2 months reports.
Great. And I think on that topic of inflation, we're bringing back an oldie but a goodie in not showing you the stale inflation numbers, but rather the live numbers.
Yeah, the stale inflation number. So the current number is about 2.4% as reported by the government. We say stale because how it's recorded is very backward looking. And a lot of it is using old housing data. If you measure live, the same inflation number calculated the same way, just with live data inputs, gives us a number of about 1.73%.
Yep. And what continues to drive these numbers or continues to keep inflation low, rather, is shelter.
Yeah. Now, look, if you're in the Northeast, you can't believe this because the Northeast market is so locked up. We can't create neighborhoods like they can in Arizona. We don't have Toll Brothers, building thousands of homes. We have a renovation here or there, right? So there's not a lot of sales going on, therefore there's not a lot of buying, and therefore prices are still kind of high. But nationally, the rest of the country, prices have come down pretty significantly and they
Hmm.
continue to come down. And what you're seeing is the national shelter metric continues to roll cooler. We show this because this is a heavy ingredient in the inflation calculation.
Hmm. Yeah.
It's more than a third of the inflation calculation. So if this is coming down, but oil's going up, they might, you know, flatten each other out.
Okay. No,
Yeah.
that's a great point. And to talk about the market anomaly section of the webinar, we wanted to address gold, as we do hear some questions around this topic right now.
So for as long as I've been in this industry, I would always tell investors when it came to gold, matters is who's buying it. And then eventually what matters is who's selling. And that still hasn't changed. What you've seen over the past year and a half is China and other countries with their excess reserves. They've been hedging the dollar by buying gold, right?
Yeah.
But eventually, if these countries have to pay for, I don't know, commodities um, or anything, they have to liquidate some stuff to create cash to pay for various things, right?
Hmm.
So, what we've seen over the past month and a half is number one, the dollar, the currency, has strengthened quickly against everything else. Number one. Number two, the price of commodities have gone up. So therefore, countries are having to pay more for the various commodities that they're consuming. And most commodities are settled in dollars. You can't pay for your stuff upon settlement in gold.
Hmm.
It is for stuff like this not an accepted form of currency. So what do? Well, if you need to create cash, you have to sell something. And what's being sold, at least by countries, is the stuff that they've been accumulating pretty significantly, which is gold.
Gold.
So gold, which usually holds up well in times of chaos, went down twice as much as the stock market. Why? Because those who have been buying it, the big buyers, had to sell it,
Hmm.
which made all the little investors worry, and they also sold it. So the price of gold over the past month has come down about 15%, simply because that theme reversed a little bit. Is there still long-term opportunity in gold? Sure. Um, but maybe with an asterisk going forward.
Yeah, absolutely.
Yeah.
And that's a really great transition, excuse me, to talk about the dollar, because there's always concerns around the dollar and will it continue to be the reserve? And so there's a great slide here to address that.
Yeah. On the left side, it is since March 1st, since the beginning of the war, the US dollar has rallied. It's the safety currency,
Hmm.
right? Everyone runs to dollars when there are issues. And like clockwork, that happened here. So what you're seeing is sort of foreign markets decline and the US dollar increase. Number one. Number two, to put out the narratives of the dollar being replaced as the global reserve currency, we won't have it in my lifetime.
Hmm.
On the right hand side, what you're actually seeing is the amount of global payments by currency, and this is over the past almost 5 years. The US dollar as a form of payment has increased, not decreased.
Yeah. And I love also that it has been incredibly consistent in regards to where the global payments have come from.
Absolutely.
Yeah,
Absolutely. But the narratives around it have been incredibly inconsistent.
exactly, which is why we
Yeah,
wanted to bring it up. No,
exactly.
thank you. Thank you. And we're in a midterm year.
We're in a midterm year. And Julina, that means that we should expect a little bit more volatility than normal.
Hmm.
This is a chart that proves it. So the max drawdown, this goes back to 1950 during these various midterm years, right? Um, there's usually a drawdown, and oftentimes it reaches double digits.
Yeah.
But it doesn't end there.
No.
1 year forward on the right hand side. Now, I want to be clear about this. This is no guarantee. We are not promising anything. But when you look at midterm years, when you measure out of the drawdown, whatever drawdown that it was in, the next 12-month return has thus far been positive 100% of the time. And the average return, you're seeing this properly, average is about a 36% return. So measure
That's
from the
amazing.
whole, from the
Yeah,
bottom during the midterm year, next 12 months is on average 36% higher, which is shockingly positive.
amazing.
Again, no promises here,
Yeah, our
but
compliance officer wants us to stress that this is not a promise, but
hence I let in with all that I let in
but
with.
what a consistent all red to all green. It's amazing to see.
Yeah, I would say you typically don't see a 100% hit
No,
rate on anything. This one is 100%.
yeah. So, but it's another reason for our optimism in the longer term. I say that like in the next 12 months relative to what we've seen over the last few weeks. So,
Absolutely.
yeah. And, a lot of concern around, what's been going on domestically. And I think this is a really neat slide to talk about why it's so hard to bet against the US.
Yeah, competitiveness of the United States. We take up about 4% of the world population. We account for 26% of the gross domestic product in the world. Of the top 100 companies by market cap in the world, we have 60% of them. 51% of the notable AI models are here in this country. We spend 27% of the global research and development expense is from this country. And on the right-hand side, it is the makeup of the S&P 500, the top 10 of the S&P 500, the global 100. The vast majority of the big companies are here in the United States. Uh, on the left-hand side of the right chart, it shows you, you're going to have to squint to see it. Back in 1912, there were bigger companies abroad, on average, bigger than the US. Nowadays, it's really mostly the US. So the United States is certainly a world leader in many things, certainly when it comes to the economic might
Yeah.
and capital markets of the United States. We
Yeah.
second place is a very distant second.
Got it. That's great. Uh, and Bob, I always love to joke on these webinars that I have my favorite slides. And mine are usually the long-term perspectives that we started with on the volatility. However, I have to say, I think our last slide may top it this for this webinar, which is the title AI could bring us together.
Oh boy. Yeah, I mean, we were chatting about this, but if AI can do this, and it looks like it will do this, that would be a wonderful use case. So this chart shows you social media on the left and how it has overrepresented extreme views on the left and right, right? Far exceeding the average view of the average person, right?
Hmm.
Looking at AI, the AI information and chat bots and conversations, because it does a fact checking and balancing, it brings the left closer to the middle. It brings the right closer to the middle and sort of voids out all the extreme stuff.
Hmm.
So when you search Google, in essence, standard Google, or Facebook for certain content, it is going to identify how you lean and what you like to read. And it
Right.
is going to lean way more heavily into your favorite leaning, right? It will
Hmm.
not try to balance you out. There will be no fact checking. It'll let you swim in the swamp that you want to swim in. AI has a much more rational approach, and it is unemotional, and it is not afraid to tell you the truth. It, it, it offsets
Hmm.
and does some fact checking to get you an answer,
Right.
and more specifically, the right answer. And that is why it cuts out the extremes. So God willing, AI cuts out extreme politics and brings us closer together. If that happens, that is another positive use case, a feather in the cap of AI. And so far, it looks like that will be the case.
So you're saying there's a chance.
So I'm saying there's a chance. Thank God,
Yeah.
Julina. So,
Well, and I think that's fascinating to me, and I hope that the this webinar, in the timeliness of what has transpired over the last few weeks, month or so, is consoling to people and to our clients, because we have received a lot of questions of, hey, has your view changed? And I'm hoping that anyone listening to this webinar can conclude, no, it hasn't changed. We're still very optimistic, and we weren't surprised to see some of the volatility. And Bob, I don't know if you have any closing comments on that.
No, the markets don't go up all the time. Occasionally, they have to take a breather. It's been a while since we've taken a breather. Technically, it's been almost a year since we've taken a
Mhm.
breather, and we're happy that this happened. It gives us opportunity for a vulnerable market. Number one, number two, it gave us some opportunity to pick up some chips, let's say here and there.
Mhm.
If the market had a bit more of a decline, which we were, I hate to say hoping for, but we were optimistic that we would be able to pick up some stuff at a deeper discount. We certainly would have. We did to a small degree,
Yeah.
but we were ready. We had a plan for the over, and we might be resuming back into the uptrend here. But you just have to remember to zoom out a little bit. Uh, don't measure daily, don't measure weekly. It's hard to measure monthly. It's
Right.
not a good indicator of the theme that's going on in the bull market. You have to measure over a longer period of time. And pullbacks, it's like running a marathon. Sometimes you have to run a slow lap so you can finish the race. And the markets just ran a slow lap so far for the first quarter. Very rare to have 2 quarters negative back to back. I'm going to say that's optimistic for this coming quarter.
Okay. That's great. Thank you so much for the insight as always. And also to the listeners, we're here if you have any questions. And if you have any feedback, please feel free to reach out to any of us at Principal Wealth. And we look forward to another update in May.
Absolutely. We'll see you in a month.
Thank you.
Thank you.